Consumers have raised concerns about the compensation structure of MLOs, arguing that it creates a disincentive for them to offer the best market interest rates. This compensation process can exacerbate unfair and predatory practices. To address these issues, it is crucial to have a consistent definition of unfair practices or treatment. The consistent definition of unfairness is found in the Federal Trade Commission Act. Congress has adopted the standard developed by the Federal Trade Commission to determine whether acts or practices are unfair under Section 5A of the FTC Act. According to the FTC Act, an act or practice is considered unfair if it causes substantial injury to consumers, which cannot be reasonably avoided by the consumers themselves and is not outweighed by countervailing benefits to consumers or competition. The FTC may also consider established public policies in determining unfairness, but public policy alone cannot be the primary basis for such a determination. The focus of any unfairness inquiry is consumer injury, which can be substantial if it affects a large number of consumers or poses a significant risk of concrete harm. States have also enacted statutes that prohibit unfair or deceptive acts or practices. These statutes often define unfairness as conduct that is considered immoral, unethical, oppressive, or unscrupulous, causing substantial injury to consumers. Based on these definitions, the board has determined that paying loan originators based on loan terms or conditions other than the amount of credit extended, or steering consumers towards loans that are not in their best interest to maximize loan originator compensation, are unfair practices. Now let's summarize the final rule aimed at protecting consumers in the mortgage market. The goal of the amendment is to protect consumers in the mortgage market from unfair practices involving compensation paid to loan originators. One of the ways this is achieved was the prohibition on compensation based on terms or conditions. Creditors or any other person are prohibited from paying compensation to mortgage brokers or other loan originators based on the terms or conditions of a mortgage transaction, except for the amount of credit extended. The rule also put a prohibition on consumer-paid compensation. No person can pay compensation to a loan originator for a specific transaction if the consumer directly pays the loan originator's compensation. The rule also put a prohibition on steering. Loan originators are prohibited from directing consumers to loans that provide greater compensation to the loan originator unless the loan is in the consumer's best interest. Additionally, the rule provides a safe harbor for compliance. A safe harbor is provided to facilitate compliance with the anti-steering prohibition. Loan originators are deemed to comply if they present loan options that offer the lowest interest rate, no risky features, and the lowest total dollar amount for origination points or fees and discount points. Finally, let's consider the rule's scope and coverage. The rule applies to loan originators, including mortgage brokers and employees of creditors originating loans. It covers all transactions secured by a dwelling, but excludes HELOCs under open-end credit plans and timeshare transactions.